Austin, thanks so much for taking the time to be with us today. Before we start, could you give us a quick introduction and provide a bit more information on what your role is at Avantax?
Yeah, thanks, Myrna. So I've been with Avantax for about 10 years now, started back in 2015 and as an analyst, and really got to get in the weeds with a lot of the investment strategies and things like that we use within our client portfolios. And over time, the team has grown, and I've been able to, I still have a lot of those same responsibilities, but I've also been able to work quite a bit more with our financial advisors and our clients from the portfolio construction all the way through the implementation phase. So that's been something that I've really enjoyed, over the last several years here, being able to take that role in a couple different directions.
Very impressive. With that, let's dive in right into some questions that I'm sure are the front of mind for many. Question number 1. How do you assess the current state of the economy, and what key indicators are you watching most closely?
Yeah, so the economy's been very strong, right? We've had the last couple of years coming out of 2022. A lot of people thought, a recession for sure. I think, the Wall Street Journal had a poll with, I think, every economist in there heading into 2023 expected a recession, and it just never came, right? The economy kept chugging along. We grew at about 3% last year and expecting somewhere in that 2 to 3% range in the year ahead, in general. So, really the economic backdrop has been relatively strong. I think that's been driven by a couple of different factors. We've had employment, which has been very strong, right? The unemployment rate's around 4% right now. That's ebbed and flowed a little bit, but overall we've got a very healthy labor market for the most part. And then you've got consumer spending. So if you think about consumer spending, that's about 2/3 of the U.S. economy. So total GDP growth each year. So 2/3 of that is consumer spending, retail sales, things like that. So as long as people are employed and spending money, the economy is probably going to keep chugging along. So we look at a number of different indicators, obviously the labor market and things like that, consumer confidence, all sorts of different, retail sales as far as the health of the consumer. There's a lot of things that we look at, but, right now there seems to be more of a, signs of a normalization. We had a lot of those metrics were really out of whack coming out of the pandemic, and the labor market was extremely hot for a while there. That's starting to cool, but we really think it's more of a normalization than necessarily a slowdown. So overall, a very healthy economy.
Thank you. Second question. The general public has a negative perception of the current state of the domestic economy, yet the stock market is reaching all-time highs. What do the markets see that the public may not be recognizing?
Yeah, so it's, this is a conversation that we have a lot. And, it's important to note one thing, on the front end is that the stock market isn't necessarily the economy. Yes, they're tied quite closely over the long term and things like that. But there's a lot of things that may be impacting consumer sentiment, their views on the economy, that aren't necessarily flowing through to the stock market. So if you think about inflation, right, that's a big one. I think that's probably the most impactful from a sentiment standpoint. And people tend to, overestimate maybe inflation or, take some anecdotes like egg prices, for example, right now, and kind of extrapolate that out into the future. Also, things have cooled a little bit. So we talked about the hot labor market a little bit earlier, back in 2022, for example, coming out of the pandemic once again, we saw a record number of job switchers. It seemed like anybody who had a job could probably get a job somewhere else and probably some more money along the way. That has, we've seen that start to cool down quite a bit as well. So I think your average consumer, from that standpoint, maybe sees, a little bit less flexibility from an employment standpoint. And then on top of that, what's driven a lot of the returns in the stock market the last couple of years? Well, a lot of it's come from the technology sector and these big growth stocks. Your average person doesn't necessarily see that, day to day, doesn't necessarily impact them. So, that's one thing that's kind of where that difference might lie there. But I think a lot of it, is ultimately tied to inflation and things like that, and maybe not as much flexibility from a employment standpoint.
Are there certain sectors or asset classes that are performing better or worse than expected?
Yeah, so technology, which is about 1/3 of the U.S. stock market, has just been on an incredible run. A lot of those stocks had done quite well. Coming out of 2020, they went significantly higher after we had that sell-off in March of 2020. And then 2022 hit a little bit of a roadblock. We saw a lot of these big technology names like an Amazon, Google, Apple. Many of them sold off, 40, 50% or even more. And a lot of people said, okay, maybe this run in tech stocks is over with, or finally going to take a breather. And then I think the real turning point was the fall of 2022. ChatGPT was finally released to the public. There had been a lot of talk for years about artificial intelligence, some of the use cases and things like that, but that was really the first time your average consumer out there could go on and start punching questions into these language models and things like that, and see just how fast and how thorough some of this artificial intelligence is. And that essentially started a whole new kind of a reset for these technology names, and we almost had a new bull market start with a lot of these tech stocks coming out of that. So there's just a ton of money being spent on artificial intelligence, a lot of it by the biggest names in the world, or the biggest stocks in the U.S., and they've got a lot of cash flow to spend, and they're spending it on artificial intelligence. If we think about maybe what hasn't performed well, so the last 10 years, U.S. stocks have been the place to be. Anything else, in particular, I guess U.S. large cap stocks. So think your Apples, your Microsofts, your Nvidias, your Amazons, your Googles. Those names have driven the bulk of the returns, and they represent a significant portion of the market. For example, the S&P 500. What I think's really been surprising is just how much they've outperformed relative to international markets, or even small and mid-cap stocks here in the U.S. So some of these smaller companies, they've done okay. They haven't necessarily, it's not like they've been down the last 10 years, but their returns have been something like half of what we've seen, depending on what you're looking at in these U.S. large cap names. So that's really been a surprise to us, and something where diversification hasn't really been needed. We don't think it's we certainly don't think it's not necessarily, but it hasn't really been needed, at least the last couple of years here.
Thanks, Austin. Moving on to question number 4. What impact do you think recent fiscal or monetary policies will have on market behavior in the short and long term?
Yeah, so in the short term, we're in the same boat as everybody else. We're trying to figure out what's going on with some of these policy changes, whether it be executive orders and things like that. There's a whole slew of things coming out of Washington right now, and things seem to be changing day to day. So we do continue to expect a lot of day-to-day volatility, particularly around things like tariff announcements. It's hard to say where those are ultimately going to land, but expect some volatility there on the fiscal front. And then you've got, a situation where the Federal Reserve is kind of in no man's land a little bit. I think they want to cut rates a little bit. They think they're a little bit too restrictive. We're currently at 4.5% on the federal funds rate. So think short-term interest rates, that's what they really control. I think they'd like to see that a little bit lower. That's certainly higher than what they would, assume to be their kind of neutral long-run interest rate. But there's a lot of uncertainty on that policy front that's, kind of leaving them in standby mode for the time being. So certainly, expect plenty of volatility there. I think, trying to handicap some of these things, it's really too early to tell what the long-term impacts of some of these different policies might ultimately be.
So you mentioned tariffs. So question number 5, considering the ongoing tension around tariffs, how do you see tariffs influencing long-term investment strategies and sectors reliant on international trade? And what should investors keep in mind?
Yeah, so I think it's important to keep in mind this. This isn't the first time we've seen tariffs. We had a trade war, and that was particularly focused on China. What's interesting about this go around is, it sounds like just this week. I guess just to back up a little bit, President Trump had announced that we were going to be looking at tariffs on Canada, Mexico, and China. China was fully expected. I think, the markets had that priced in. There was no surprises there. What really was surprising was, how steadfast he seemed on, implementing some 25% tariffs against both Canada and Mexico. That quickly reversed. The markets didn't like that when that was originally announced, and he pretty quickly shifted course on that front. But then just this week came out and said that, he plans on implementing these as soon as March 4th here. The markets haven't really, respond. We've sold off here a little bit the last few days, but it hasn't been anything all that substantial. We're still within a few percent of all-time highs, depending on which index you're looking at. So the markets really seem to be discounting a lot of what the new administration is saying, or at least believing if this stuff is implemented, it's going to be relatively short-lived. We do believe there could be some relatively significant impacts from tariffs in the short term, but ultimately a lot of these supply chains, a lot of these businesses, they've got essentially record margins and things like that. So there might be some room to chew up some of those price gains and things like that. So long term, it's not something we're overly concerned about. We think it'll be relatively short-lived, but in the near term here, it's really hard to say on a day-to-day basis. But wouldn't expect to see some further volatility going forward. It's really a fluid situation and just changing day to day.
Yes, very fluid. Okay, moving on to question number 6. How do you view inflationary pressures in the economy right now, and how do they impact investment strategies?
Yeah, so inflation is one of those things that's, we've talked about it a lot, just about everybody the last several years. I think the good news is it's less of a concern now than ever in the last couple of years. We peaked at about 9% in 2022 with inflation, and now we're back down in that 3% range, depending on which measure you're looking at. So still a little bit high. The Fed wants to see 2%. That's their long-term, and that's a stated mandate as part of their price stability. They want 2% inflation. We don't think we're going to get there anytime real soon here, but we're awfully close. So, Friday we're going to get their preferred measure of inflation comes out, which is the PCE price index. That's looking like it's going to be somewhere in that 2.5% range. So still a little bit of a ways to go to 2%, but not that runaway inflation that people were concerned about. I think for the most part, a lot of those upside risks to inflation have mostly kind of worked their way out of the system. Now, with that said, you will hear some talks about what tariffs might do to prices and things like that. The good news on that front is you might see that supply and demand balances shift a little bit, or whether it be immigration and things like that. We don't think that's going to have a substantial impact on inflation over any meaningful period. There's the economist opinions and things like that are, there's pretty wide dispersion on how those things could impact inflation. But at the end of the day, we think, any inflation that might come from things like tariffs would be more of a one-time hit. And that's really not what the Federal Reserve is concerned about. They're more or less worried about keeping longer-term expectations anchored around that 2%, which so far they've done a pretty good job of.
Okay, thank you. Question number 7. Central banks have been adjusting interest rates frequently. How do these moves affect financial markets and investment decisions?
Yeah, so interest rates affect a lot of things, and we've had a ton of volatility. The Fed has been very, very active with short-term interest rates over the last several years here. So if we back up, they started hiking rates in we were essentially 0% for at interest rates coming out of the pandemic. And then inflation, it became pretty evident that inflation wasn't going to go away on its own. It was way higher than we've seen, in decades. And so the Fed started hiking rates basically from 0% to 5.5% over the course of 2022 and 2023. Inflation, pretty quickly. I mean, it took some time, but pretty quickly started to slow, and some of that had nothing to do with the Fed. It was supply chains and things like that. That just kind of came back into balance. But, at the end of the day, they started cutting rates again in September. As far as how that impacts your investments, if you were sitting on money market or had a lot of cash, right, you were earning, call it 5% in a money market account or something like that for the last year or so. Now you're seeing those rates back down, closer to 4%. So that's kind of that immediate impact that you can see from central bank policy and things like that is really in those short term. It's interesting, like the 10-year Treasury bond, the yield on that, the Fed doesn't really control all that much. Over the long term they can control, but to an extent. But the yield on the 10-year Treasury bond has actually moved higher since the Federal Reserve started cutting interest rates in September of last year. So that's just kind of an interesting anecdote. Housing, if you think about mortgage rates, they're not tied to the federal funds rate, which the Fed controls. They're more or less tied to 10-year treasuries. That's why you haven't seen mortgage rates come down, at least as much as you might expect, given that the Fed has cut interest rates by 100 basis points since last fall.
Thank you for that. And question number 8. How do you think global events such as geopolitical tensions or supply chain disruptions are shaping the economic landscape?
Yeah, so I think on the supply chain front, we learned a lot during the pandemic about just how fragile some of these supply chains can be. The whole just-in-time delivery. Now you're hearing about more, just in case as far as inventory management goes. So we did learn a little bit about just how fragile some of those systems were. I think we're going to see more diversification, and we're already starting to see that. Not as much that everything's going to necessarily come back here to the U.S., but diversification away from China, right? So we've seen Mexico, Vietnam, areas like that have been some of the primary beneficiaries of that, I think, at least, in the data in the interim here. And I think we're going to continue to see that. But on the geopolitical front, you've got, the war in Ukraine, which, European stocks have been, kind of pricing in the fact that might come to an end here sooner than many people thought. There's talks about a deal for critical minerals and things like that between the U.S. and Ukraine. So, keep an eye on that. The thing with geopolitics is, if you were to, there's been some studies and things like that, how did geopolitics impact the markets? Does it make sense if you knew it was going to happen on the geopolitical front to invest with that knowledge? A lot of it doesn't really matter. It's one of the poorest indicators of short-term market performance and things like that. So yes, volatility, but directionally it's hard to say where that might go. And ultimately, usually within a few months of these things, starting obviously when, Russia invaded Ukraine, we saw, some of the commodities and things like that move significantly higher. The market sold off a little bit. Interest rates moved down some. Most of that had normalized within a month or two. So geopolitics, there's certainly something we watch. And generally they're isolated to countries that maybe just don't have that big of an impact, on a global scale, in the Middle East and things like that. Russia was a little bit of an exception on the energy, oil and natural gas front. But a lot of times they're just not all that impactful. So, like I said, certainly things that we watch, but, from a portfolio standpoint, long-term, not something we're generally positioning around.
Okay, thank you. Question number 9. What's your view on emerging markets in the context of current global economic environment? Are there opportunities or potential risks there?
Yeah, well, I think anytime you're talking about emerging markets, risk is certainly, going to be top of mind there. There are some very volatile markets there. You've got, currencies that are less stable than the developed markets and things like that. So certainly a little bit of an extra layer of risk there. Emerging markets, you can't really talk about emerging markets without, discussing China. You've got to have a view on China because China is roughly 1/3 of that emerging markets index. So the emerging markets index is like the S&P 500 is to the U.S., but for emerging market stocks, Chinese companies are about 1/3 of that index. China stocks haven't really gone anywhere the last 5 or 10 years, been pretty well flat after a pretty good run in the early 2000s here. So, emerging market stocks have lagged. They've been more volatile. And just looking at these past several years, you would say, does it make sense to own these? We think that there are some diversification benefits from a currency standpoint. You can get exposure to, some of these, China does have a lot of technology stocks and things like that, are in on this artificial intelligence and things like that. And a lot of these markets are generally cheaper. Rightfully so, though. There's a lot of reasons you may not want to invest in areas like China. Or if you look at a market like India, which had done exceptionally well, that economy is growing, at a pretty impressive clip. However, India, those stocks, if you think the U.S. stocks in the U.S. are relatively expensive, they're trading at virtually the same multiples in India. So, there is some of that balance. And so we think it does, emerging markets can make sense for investors, particularly those with long time horizons and things like that. But we think you want to be pretty thoughtful about how you might allocate there. We tend to prefer, not just going with, just a passive manager in that space, but somebody who is active in consideration, some different things versus just owning everything blindly, because there are a lot of state-owned enterprises and things like that that may not have the shareholders' best interest in mind necessarily.
Okay, great. How is technological innovation shaping the future of investments, and are there any new trends you see as particularly impactful?
Yeah, so I think there's really been a lot of positives for investors on the technology front. Anybody pretty much anywhere in the, can go on their phone and trade anything from stocks to bonds to cryptocurrencies to artwork in certain cases and things like that, with the click of a button on your phone. So that's certainly made investing much more accessible to a lot of people. One thing I do worry a little bit about is maybe the gamification of investing a little bit, particularly for the generation who maybe just started investing during COVID when there wasn't a whole lot else to do, and opening up these brokerage accounts and things like that, and making really risky day trading type plays and things like that. Not that that's not okay to have some fun in the markets and things like that, but I think they may have missed some of the merits of long-term investing along the way. But overall, I think it was a net positive, or a lot of this technology is a net positive, because the more you can make investing accessible to more people, I think the better off everyone will be in general. So that's kind of on the what everybody else is seeing. On the wealth management front, it could be a full-time job just trying to keep up with all the new technology available to firms like us and things like that. But one area specifically is things like tax loss harvesting has become much easier than it was several years ago when we were manually looking at thousands of different accounts on a weekly basis to do that. Now we've got software that can do the bulk of the heavy lifting there with a little bit of oversight from the team, or things like householding, and a lot of the new financial planning software and things like that makes it a lot easier for the masses to get very high quality financial advice that maybe would have been reserved for the ultra high net worth type people several years ago because of the advancements in technology.
Yeah, technology's been great for both your sector of the business, but also for tax. Moving on to question number 11. In the current economic climate, how do you weigh the risk-return profile of traditional equities or bonds versus alternative investments like real estate, commodities, or private equity?
Yeah, so there's always a trade-off between the risk and return. With stocks and bonds, generally the stocks are going to be on the riskier side of things, and bonds on the safer side of things. And then you've got alternatives in there as well. So I guess really quick, we should make an important distinction between alternatives. So there's what we consider to be like traded alternatives. So consider like commodities funds that maybe hold futures contracts and things like that, or physical gold or silver, whatever it may be. And then traded REITs or real estate investments. Those are very accessible. Relatively low cost, and you can trade them just like any other stock or bond in a brokerage account. Then on the other side of the alternatives are things like private equity or private credit, non-traded real estate, things that maybe aren't as accessible, and the concerns that we have with some of those products at times. We certainly utilize them. They can make sense for certain clients, but they're much less transparent. The fees tend to be a little bit higher, and the liquidity is the big one, right? If you buy a stock or a bond tomorrow, you can go sell that relatively easily, and you're not going to take a big haircut or anything like that. If you're in a private equity deal or some sort of alternative, you may be tied up for 10 years plus before you have any sort of liquidity. So that's really something that's we try to help our clients navigate, just to make sure they understand some of those trade-offs. But we do think the balance recently has shifted. A few years back, bonds were yielding essentially nothing. So your expected returns there were not very high, and it's been a really tough run for bonds here the past few years, as rates went from effectively zero to north of 5%. Now, that balance has shifted back a little bit where we think something like a 60-40 portfolio, is kind of back in business now because you can get, expect somewhere between 4 to 5% in high quality, treasury bonds and things like that, which is, can really do a good job of supplementing whatever you're doing with the stock portion of your portfolio. And, with rates a little bit higher, we also think there's more potential for bonds to once again kind of diversify against the rest of the stock market. So if the economy really starts to slow down, maybe the stock market doesn't do quite so well, the Fed is probably going to have to start cutting interest rates pretty aggressively, and that should, be another benefit for bond investors. So we think that, the diversification benefits of bonds are finally swinging back into balance, whereas, we would have had a different answer to that question just a few years ago.
That's very informative. Thank you. Question number 12. The new administration has emphasized bringing manufacturing jobs back to the U.S. How do you see these efforts influencing the growth of the domestic manufacturing sector?
Yeah, this is another hard one to try and forecast right now. Ever since China joined the WTO in the early 2000s, industrial production, a good gauge of manufacturing, has more or less been flat here in the U.S. So, there's a lot of things that we can try and do, but that's not just going to change, shift back overnight. A lot of those supply chains, a lot of the production, it takes a long time to establish some of that. And then if you think about these high, if you think about artificial intelligence, these GPUs and semiconductors and things like that NVIDIA is designing, for example. Well, guess who's producing all those? That's Taiwan. That's Taiwan Semi. They have the most high tech, capabilities on that front. It takes years and years to build that type of capacity out here in the U.S. So, we think it's probably going to be a net positive. But, I would kind of keep your expectations, in check on that front, because a lot of that's really hard to change overnight and, maybe over the course of 4 years, for example.
Mm-hmm. All right, moving on to question number 13. What's your perspective on the real estate market now, both residential and commercial, given current economic conditions?
Yeah, so this is an interesting one because, as interest rates moved higher, most of real estate was all kind of lumped together with office space. So you had, seemed like everybody was working from home during the pandemic and things like that. And everybody said, okay, office real estate, but they would say commercial real estate is going to crash. And, there's some truth to that, right? A lot of these office properties and things like that have not done very well. But they're a very small portion of the broader real estate market, right? We've had things like cell towers, data centers, which have really been in, the demand for those has been pretty incredible, and the returns have been quite strong on a relative basis. So, it's important to decipher between the different areas of commercial real estate. If you think about, it seems like some of the higher quality office spaces have recovered and, may continue to do so. Some of the lower quality spaces, particularly in cities with a lot of vacancies, may not do quite as well. Anecdotally, it'll be interesting to see what happens in D.C. with a lot of the budget cuts and things like that. You hear some talks about just a crazy number of house listings and things like that on the market there. So that'll be just something to keep an eye on, but, probably won't impact the broader market. And then from a housing standpoint, right, I think everybody feels this. If you're sitting on a house with a mortgage at, 3%, you're feeling pretty, okay. You don't really care what interest rates are doing here the last few years. But, if you're looking to be a first-time home buyer, it's gotten incredibly, expensive to buy a house. Not only do prices continue to go up, but now you've seen, mortgage rates, essentially triple to sub 7% a little bit right now. We've seen that back off a little bit the past week or so here, but you've got rates exceptionally high, prices very high, and I think a lot of that, the Fed can only do so much with housing because there's such an acute imbalance between supply and demand right now in the housing market that. We don't think houses are going to get exceptionally cheap anytime soon here. What that growth looks like and things like that is hard to say, but we think there is a significant amount of demand that's probably going to continue to weigh on the supply side of the equation.
Great points, Austin. Okay, question number 14. For individual investors looking to protect or grow their wealth in the current economic environment, what advice would you offer?
So yeah, we talked a little bit about market concentration and all the tech stocks and things like that here in the U.S. It has led to a very concentrated market. So, if you think about it, roughly 40% of the S&P 500 is in the top 10 stocks. So that means if you own an S&P 500 fund, which is diversified in a sense, it owns a lot of names, but almost half of that is in just 10 stocks. And, it just so happens that a lot of those happen to be customers of each other. For example, Microsoft is buying a lot of chips from NVIDIA and things like that. So that's, we think it makes sense to maybe review what do you currently hold, maybe these mutual funds and ETFs that you hold in your portfolio or individual stocks may not be as diversified as you think. So we think that certainly deserves a second look. Just broader diversification in general, right? We talked a little bit earlier. It hasn't worked. It hasn't really been needed the last 10 years more or less. But if you zoom out a little bit further from 2000 to 2010, U.S. stocks, the S&P 500 was actually down from 2000 to 2010. Whereas international, emerging markets, small cap stocks, everything else was higher. So I think by being diversified, we're not saying you need to own half your portfolio in international stocks or small cap stocks or anything like that. But we do think it makes sense to stay diversified, particularly when we've seen such a run up and such a high level of market concentration. You may miss out on a little bit of the upside from time to time, but I think, in the environment where the market, where the leadership starts to shift a little bit, like we've seen so far this year. We've had a lot of head fakes in the past, but international stocks, believe it or not, with all the tariffs, China's market's one of the best performing countries here so far year to date. So, that's kind of one you wouldn't necessarily expect. So we do think it makes sense to have some exposure outside of the U.S., outside of these big technology stocks, and things like that.
Great advice. Thank you. Last question of the day. With tax season approaching, what advice would you give to high net worth individuals looking to optimize their tax planning while managing their portfolios?
Yeah, so with the markets performing quite well the last several years, there's probably a lot of people out there that have a ton of unrealized capital gains in their portfolios, maybe in mutual funds or exchange traded funds, but maybe in individual stocks as well. And it just so happens if they're in the individual stocks, they maybe some of the larger positions in the funds you own as well. So I think, taking a look at what, what those capital gains look like within some of those positions, working with, with your CPA, with a financial professional can help you really analyze what does that trade-off look like. Maybe you've got a ton of Apple stock, for example. How much of that can you afford to hang on to, right? It may be the case that, you've got enough money elsewhere that it doesn't really matter. You could afford to take some more risk by owning, half of your portfolio in Apple or something like that. But there's a lot of clients that we work with and we go through different scenarios and say, well, if this stock sees another year like it did in 2022, that may permanently impair, what you're trying to do long term, what the terminal value of your portfolio could look like depending on the timing and things like that. So, I think those are really important things. And then, making sure that, your assets are located in the appropriate places. Make sure if you've got, a fund or something like that that's maybe not very tax efficient, try to hold that in an IRA account, which is, we do a lot of that kind of at a householding level. Take advantage of tax loss harvesting opportunities when they exist. That's something that we do, pretty consistently for the majority of our clients, and it can really help. And when back in 2020, for example, the market was down 30% by March or so. We were able to harvest a lot of losses, keep our clients invested by swapping into something very similar, and then they were able to ride the wave higher because we ultimately finished 2020 higher in the markets despite that sell-off. But then now, as we're going to rebalance and shuffle some things around, we've got losses that we can maybe use to offset some of those things. So I think that's important as well. And then the last thing I'll touch on is just, there's the rise of exchange traded funds or ETFs compared to mutual. They've really kind of taken the mutual funds anymore, have taken the back seat a little bit to ETFs and other direct indexing like strategies and all sorts of things. Mutual funds still have a ton of assets, but we're starting to see those flows really turn in the favor of exchange traded funds, which you can access a whole host of, of different things through those funds. And just make sure, if you're going to buy some of that stuff, make sure you know what the tax implications are. We've had clients that before they came to us, maybe bought an ETF and they didn't realize that it paid a K1 and they were waiting on that for their taxes, or, things like that. I think working with somebody who kind of knows the ins and outs, a lot of that stuff can help, just make sure you kind of know what you're getting into, so there are no surprises come tax time.
Austin, this has been wonderful. Thank you again for taking the time to be with us today. We appreciate your thoughts and insights, and we hope we can have you back here in the future.
Yeah, absolutely. I appreciate it.